This is certainly a pre-election budget aimed at the voters who are going to get this government across the line at the next election. We're hoping for meaningful tax reform, but that hasn't happened. 2018 has seen slow wage growth and inflation below trend, but commodity prices have been strong and employment growth has been good. That's led to a strong foundation for this budget. This measure has a short-term plan to get more money in people's pockets. The government is trying to get people out of a saving mode and into a spending mode. There's a long-term plan to address tax bracket creep, but there's many elections between now and then. This measure is supposed to make tax simpler, but I'm yet to understand how. The government is continuing their infrastructure spending across Australia. Local businesses can grab their piece by contracting their services to the project coordinators. The 20k instant asset write-off has been very popular, so it's no surprise that the government's extended it. This will allow small business to acquire a plant or equipment for less than $20,000, and instead of depreciating that over time, they get an immediate deduction in the year they acquired it. There certainly has been some changes to R&D this year. For businesses with a turnover of under $20 million, the refundable amount is now capped at $4 million per year. Businesses might find they start to structure their spend and activity to better align with this capped incentive. For businesses with a turnover of over $20 million, the R&D level of claim is now dependent on how much of your expenditure is being spent on R&D activities. The total expenditure you can now claim has increased from 100 to 150 million, so this will really benefit those businesses that have R&D at their core. The government is aiming this measure at those businesses who gain an unfair financial advantage over those who pay their taxes on time. The ATO has had a haphazard approach as far as who they target for debt collection and how they go about it. It will be very interesting to see whether this standardises the ATO's approach in the future. Having more family members in the SMSF could lead to having a larger pooled family wealth fund. Theoretically, this could lead to a reduced per person cost of running the SMSF. Strangely, this measure is contrary to the government's view that an SMSF shouldn't be an intergenerational wealth vehicle. The government's budgeting a slim surplus for 2019-20. It'll be interesting to see if this happens, but I'd be more interested to see if they hit the larger 2021 surplus. And I'll celebrate that big surplus knowing that my craft beer is a little bit cheaper.